Hello, it's ChewDog Charts, and today we're going to continue our talk about bonds because bonds are so important to the economy, and I expect the rise in bond yields to be the cause of the next correction. And just yesterday, Goldman Sachs came out with a report where they see a high probability of a stock market correction in the coming months. According to the report, Goldman Sachs believes that correction signals are flashing, and it's advising its clients to prepare for a correction in the coming months as investors pour cash into the stock market. Whatever the trigger, a correction of some kind seems a high probability in the coming months. Our Goldman Sachs Bull Bear Market Indicator is at elevated levels, although the continuation of low core inflation and easy monetary policies suggests that a correction is more likely than a bear market. The S&P 500 has entered the longest period since 1929 without a correction of more than 5%. And while bear market risks are low, we wouldn't be surprised to see a market re-rating in the next few months. Drawdowns with bull markets of 10% or more are not uncommon. The average bull market correction is 13% over about 4 months. Now, in my opinion, a likely culprit of a correction is going to be higher bond yields. So this video is more of a continuation of the stocks and bonds video I recently completed. So let's take a look. The Dow Jones Industrial Average rose 25% in 2017 and became one of the best performing global asset classes. Now, it's a different story for U.S. Treasuries. The yield on a 10-year Treasury note fell slightly from about 2.44% at the end of 2016 to 2.41% at the end of 2017. And the spread in the yield between the 2-year and the 10-year notes, which is often a signal of a slowing growth or potential recession, narrowed from 125 basis points down to 51.8 basis points by the end of 2017. As investors get different messages from equities and treasuries, we need to pay particular attention to the bond market in making asset allocation decisions. And it's important to note that treasuries have been a better predictor of the two recessions in the 21st century. The first lasted from March to November 2001, and the second recession lasted from December 2007 to June 2009. In the 2007 to 2009 period, bond yields fell during the months before the recession, whereas stocks remained strong well into the first half of 2008 when the economy was already in a downturn. So there's good reason to believe that treasuries are now sending a warning signal. The recent rise in stocks resulted from corporate earnings that exceeded consensus estimates, and lately the reduction in the corporate tax rate to 21% from 35%. Regardless, the decline in bond yields signals that the rise in stocks may not be accompanied by faster economic growth. Narrower spreads between the 2-year and the 10-year treasuries also reflect speculation that the Fed's stated objective of raising the federal funds rate 3 times in 2018 may not be met. If the economy slows significantly after an initial burst of optimism over the tax cuts, the 10-year yield is likely to fall further even as the 2-year yield rises with the Fed tightening, eventually resulting in an inverted yield curve. And the yield curve inversion often can signal the recession. And it did so in 2001 and in the 2007-2009 timeframe. While recessions have always been preceded by the 2 to 10-year spread going negative, a negative spread does not always end in a recession. Now, looking at this chart here, you can see with my cursor here that every time that the 10-year yield approached the trend line, there was a sell-off in treasuries, and also it indicates a peak in the S&P 500 as shown here as well as up here. And over here in the 2007-2008 time frame, the 10-year yield actually pierced through the trend line, and it also coincided with the peak in the S&P. And here we are now in the current time frame. The 10-year yield has just pierced through the trend line. What's important is to remember that a big factor for a potential correction is that personal, corporate, and governmental expenses all increase with a rise in the bond yield. And as you can see from this chart here, which simply shows the federal government current expenditures, the interest payments, you can see that the interest payments way back in 2002 were quite low compared to where they are today in 2017. So you can imagine that the federal government expenses, the interest expense, is increasing quite dramatically, but the same thing is happening for personal and corporate expenditures, such as for auto loans, credit cards, student loans, and home mortgages. They're all increasing quite substantially. And so as another backdrop with regard to the rising interest rates, along with the corporate debt, governmental debt, and personal debt, at the same time, the federal receipts, in this chart here, the federal receipts as a percent of gross domestic product, the federal receipts drop. And you can see the correlation between the drop in the federal receipts and the gray columns, which are the recession periods. And you can see here at the far right on the chart that the federal receipts have been dropping and have now gone negative. So let's take a look at our last chart. And this chart here gives a good summary of the perspective that I'm talking about. And the important things to keep in mind is the blue line, which is the 2-year Treasury, and the red line, which is the 10-year Treasury. And as you can see, when the 2-year Treasury approaches the 10-year Treasury line, that's the tightening or the narrowing of the yield spread. And oftentimes, but not always, but oftentimes when it narrows, when that spread tightens and narrows, it often presages a recession or a crisis in the economy. And at the right part of the chart, you can see that the 2-year Treasury is approaching the 10-year Treasury line. So we need to keep our eye on that because expenses, all corporate, government, and personal expenses will be increasing, and that may presage another recession or potential crash in the market. So let's keep our eyes out. So for today, that's ChewDog Charts. Thank you.